Let's just start off with the equity front. As I said, stocks are cheap, and as a result, we've seen investors, particularly foreigners, coming into the market and buying into some of the banks like Equity Bank. This is really a good sign of confidence in the Kenyan equity market.
Thank you for having me on the show. I think for the foreign investors, the appetite has definitely been positive for some of the key banks, especially Equity Bank. And this just goes along what happened yesterday. There was the press communique that came through the Central Bank and the Kenyan Bankers Association, just giving insight on what the industry will be doing to counter the rising rates and the rising risk of default on the loans. And I think of all these banks, Equity sits in a much stronger position. And if you're going defensive on the Kenyan stocks, especially on the Kenyan banking sector, then Equity Bank would definitely be your fast call.
There's been a lot of concern around Carb Bank. It seems that stock has been down some 19% in the last month. Is that all around the capital adequacy levels that the bank is sitting at?
There's been a lot of speculation on the bank's capital adequacy ratios with a lot of market rumors going to alluding to a rights issue or a capital raise in that respect. But I doubt if there'll be any capital raise, at least on the equity market for the next year or so, given the downward pressure and the downward momentum of the Nairobi Stock Exchange. And I think also just based on the fact that banking growth will be much less stellar than what we saw this year. This year they've done 37% for the industry. So next year we'll definitely expect single-digit numbers. So if you're not growing your loan book as fast, then your capital adequacy ratios won't be thinning at a faster rate as they were in the previous year. So I think for them, 2013 will probably be a better bet to do a capital raise. Interesting,
though, that Standard Chartered still online for that capital raising next year, though.
I think for Standard Chartered and for Barclays Bank, you sort of tend to have not an indigenization of the banks, and their strategy is more of a global strategy that's set out of a rolling period that they have to execute, which is very different from some of the local banks that are held by local shareholders and are very prone to being proactive and being reactive to what's happening on the ground.
On average, when we're talking about capital adequacy ratios, how strong are Kenyan banks at this point in time?
Kenyan banks are very strong, actually, when it comes to the adequacy ratios. And I think what has been more of a concern is whether the local banks, more so the small tier banks, meet the ratios that have been set by the central bank. And more importantly, whether they meet the threshold of getting to 1 billion Kenya shillings in terms of their capital outlay. And most of these banks have actually crossed over that threshold. I think the key concern would not be more on capital adequacy ratios, because we expect loan growth to come to almost a standstill in the next year, which means you can actually run your business based on your current funding. But the key concern for the Kenyan banking sector will be more on the non-performing loans, which will be something to watch out for in the coming year.
Let's look at the, staying in the financial space, let's look at a mortgage lender, Housing Finance, announcing that it's likely to generate more revenue from the housing construction part of its business. This really a positive signal then around where the construction and the housing market is at this point in time.
I guess you could look at it from that angle, but I'd be a bit more pessimistic on it, because for you to actually produce your houses, you need to be able to have people who can afford and demand the same houses that you're bringing on board.
Yeah.
And I think now, for instance, Housing Finance raised its lending, its mortgage rate to 25% for new loans. So it's not very easy for you to actually wake up and go buy a house. You have to actually think through how much your monthly repayments are going to be. What it means is that your monthly repayments have almost doubled from last year to the next year. So
yeah.
It's one thing to be able to supply an undersupplied market, but then the affordability of this supply is definitely going to go up the roof. And then the question remains, who'll be able to afford and be able to continue providing the demand pipeline for this successive construction units that the bank will be engaging in.
Exactly what I was thinking. So given where interest rates are at this point in time, do you think Housing Finance being a little bit bullish? And would you get exposure to a company like this, which is really concentrated in the mortgage space?
It's considered on the mortgage space, but I don't think the exposure on the construction, which is the supply end of the sector, is as much as the mortgage sector of this company. I think what would be key to look at is just to see how this new strategies by the banking sector are going to pan out. For instance, they'll be rolling out, extending the loan repayment periods, and the focus is just to try and maintain a more or less similar repayment profile. that has been there over the last year or so. So if they're able to roll out some of these policies and maybe extend your loan payment period by maybe another 5 years because the mortgages are longer dated, then the instance of NPLs becomes much lower and downsizes the risk associated with a mortgage company like housing finance.